Okay, chapter 6, accounting for merchandising inventory. As you remember, last time we started with this, with the merchandising inventory, and we saw last time what's the situation when we purchase the inventory and when we sell the inventory. And there are two types of different inventory system that we may have in our company. One is the perpetual system, the other one is the periodic system. So what we saw last time, if you still remember, on the perpetual system, we saw that for the purchases, we're using only one account. Everything goes to the inventory account. Since the inventory is the account that is automatically updated from our software. And then the periodic system, for the purchases, we're using different accounts. We're using the purchase account, we're using the purchase discount account, we're using purchase return and allowances account, so we're choosing freight account, freight in account. And at the end of the period, we have to close these accounts. We're going to practice today closing those accounts. For the sales, under both system, there's a lot of similarity in this in terms of accounts. Both system were using the sales return, sales allowances, and sales discount accounts. However, the difference is that in the perpetual system, every time when we do the sale, we actually are able to calculate cost of goods sold, and we're recording the cost of goods sold with the sales. At any point of the sale, we're recording cost of goods sold. When in a periodic system, we're not doing that. We're doing only one cost of goods sold, and that's at the end of the period. And for the cost of goods sold, we're coming with the calculation with all the purchases, less the purchase discounts, less the purchase return allowances, plus the freight, plus the beginning inventory, minus the ending inventory. Once we count the ending inventory, we come up with cost of goods sold. Now today, we're gonna still building on cost of goods sold and the ending inventory, but we're gonna see that we have a different inventory method that we can use for our either perpetual, either periodic system. So let's go with the perpetual first. For the perpetual system, again, everything is updated in the accounting software. So at the end of the period, what we're gonna do, we're gonna do one physical count and make sure that the number that we have in our system matching the number that we have on the shelves or actual inventory. So the cost of each unit of the inventory will be the purchase price plus minus the discount, minus the quality discount, purchase discount, plus any cost which is necessary to prepare that item to be ready for sale, including freighting, custom duties, and insurances. Now, the value of the ending inventory cost of goods sold, we're going to get it from the financial statements. So let's consider this in the 3 months period where the boxes of tea were purchased. Now we're going to include the discount and transportation, everything. The first month we're purchasing 55 per each box. Second month we're purchasing 60 per each, and third month 65 per each. Now the question is, how are we going to assign the cost for the item that we actually sell? How would you know that? How would we know that the item that we're selling is from the first month, from the second month, or for the third month? We don't know that. So for that reason, now we're going to start seeing how many systems we can use to actually start assigning the cost to the cost of goods sold and what's going to be the value of our ending inventory. We have three methods, common methods. One is the specific unit cost method, which identifies specific item. So, for example, one example that here they're using is the car dealership. The other example will be if we're dealing with, let's say we are art gallery. In the art gallery, every painting that we have or every art that we're selling comes with a cost, which is cost is unique. And then the selling price of the every art will be different. So when the client comes, he doesn't ask for, can I buy 5 paintings and how much I'm going to be price per painting, total. Can you give me like a discount if I buy five paintings? That's not going to happen. So how it's going to be? He's going to point specific painting and going to say, can I have this? And how much is the cost? And that's how we're using those specific unit identification. That will be very unique inventory business that we can run, and the merchandising that will be very unique. Every inventory item has uniqueness, and for that reason, we're gonna using this unit identification method. For the first in, first out, now we're selling a little bit identical units. However, they're coming with a different cost. So once that we sell them, first we're selling the one we purchased first, and the one we purchased last are the one that's staying in our ending inventory. On the weighted average cost, what we're gonna do is every time when we do the purchase, we're gonna calculate the weighted average, and that will be the cost for the units that we sell. So we're gonna start doing with the example, and you're gonna see with the example. So the first thing first, here, as you can see on this picture, what's happening with this picture, we have 1, 2, 3, 4 different type of boxes. Every type of box comes with a different cost. As you can see, in total, we have 1, 2, 3, 4, 5, 6, 7, 8, 9 boxes. Now somebody's coming and picking 1, 2, 3, 4, 5 boxes. That means we left with 4 boxes. Now the question is, which boxes this person pick up? And which boxes we actually sold? So the unit identification is since every box comes with the unique price, we're gonna see how many of the dark blue boxes we're selling, how many of the yellow boxes we're selling, how many of light blue boxes we're selling, how many of the red boxes we're selling. And that will be determine our cost of goods sold. The item that left is, since again they're very unique with a different color, uniqueness color, and they're coming with different price, we can easily calculate how much will be our ending inventory. So in this case, we have available boxes total cost for 24. We sold 13, obviously 11 is going to be left. That's with the unit specific unit identification sales. Now with the first in, first out, which item comes first, that item we're selling first. So in that case, in our inventory, since the last that we purchased was the 4 boxes, the yellow boxes and the dark blue boxes, when somebody come and pick 5 boxes, the last 4 boxes that's going to be left in our inventory will be the last 4 purchased, which are the blue and 2 of the yellow. The beginning one, the light blue and the red and 2 of the yellow, those are gone. So now I can see, in this case, we're going to have a different cost of goods sold and different balance for the ending inventory. The last method is weighted average. What we're going to do, we're going to see how much we pay for those 9 boxes. We pay $24. Divided by 9, that gives us average price per box. When somebody comes and pick up 5 boxes, it doesn't matter which boxes he picks because the price is average all assigned to those boxes. Ending inventory, the same average cost will apply for the ending inventory. Now let's do some actual calculations so you can see how this actually works. We're going to use this information here for this company. They have a ending beginning balance of the inventory. They have purchases and sales, purchases and sales. So first method that we're going to see is the first in, first out method. So I'm going to open the Excel spreadsheet. Actually, I already did this in the morning, so I have some advantage. And I'm going to have a jump start with you today. I'm going to use this information, but we're going to start developing one after another. Let me do some little changes here, and we're going to start writing. Let me share my screen now. And let's go with our information. First thing first. This is what happened in our reality in our company. They're purchasing inventory. They had the beginning balance on November 1st. And on November 5th, they purchased 60 units at $11. And that cost them $660. On November 15th, they sold 30. We can see the selling price is 25. On November 26th, they make another purchase of 70 units. And they purchased those 70 units at $12, which they also come with cost. And November 30, they make a sale of 90 units at $25 again. So now the first method that we're going to use is the first in, first out. What that means? That means every time when we have a sale, we have to adjust the inventory balance and see which one we sold, which one left. And usually always the last one purchased is going to be left in our inventory. So let's go. First, we have November. That's our beginning balance for the inventory. We have 10. Then we have the first purchase of the 60 units on November 5th. So at this point, question is, how many units we have available? And we can easily calculate that we have 70 units available for sale, and the total cost for those units is $760 right at this point. Okay. So on November 15, we sold 30. We have the sales price, $25, and we have the total sales. But this one helps us only to calculate the sales. So the sales in this case will be equal to $750. That's how much we're going to charge the client. Now the question is, what's the cost of those 30 units that we sold? Now, since we're using the first in, first out, obviously the units sold, the first 10 will be from the beginning balance, which come with the cost of $10. And then the next 20 that we need to sell, let's go with minus here, first 10, it's going to come with T. And then next 20, they're coming from the purchase from November 5th. That purchase was for $11. Now I can calculate the cost of goods sold. And the cost of goods sold will be equal to this one time 10. So my cost is 100 for the first 10 and another 220 for the other 20. So the total cost is $320. So my cost of goods sold at this point are equal to, let's use the bracket now, this one plus, so my cost of goods sold are 320. That's the value of my cost of goods sold. And at this point, I can calculate my gross margin, which is the first calculation that we need for the merchandising company to get how much profit we're generating from the sale of our inventory and merchandising order. So we're getting $430. Now the other question is, once we do the sale, how much left? So inventory on hand at this point will be, we had 70 before the first sales minus the 30 that we sold. So now we have 40 units. The question is, what's the cost for those 40 units? Well, since we already know that those 40 units, there's no way we do still have any of those 10 units from the beginning inventory because those already been sold first in, first out. So the only options for those 40 will be for our purchase from November 5th, which purchase is at $11 each. So the cost of my inventory available, it will be equal to 40 units times $11, and the cost is $440. Now let's think about it. We already know we had available for sale 760. We reduced the inventory with 320. How much left? $440. Do we have $440 left? Yes. Why we have those? Because we have 40 units and the very last purchase for $11 each. Okay, great. Now let's do another purchase. Then our next purchase is on November 26. On November 26, we're going to purchase another 70. Now, at this point, how many we have available to sell? Let's see how many we have. Now we have 40 from the left on the purchase on 5th and another 70 from the last purchase that we have 110 units. A total cost of $1,280. After this, we're selling. We have sell on November 30th. And we sell 90 units. Now the question is, after we sell those 90 units, from where are we getting them? First, we're going to take the one that we have at the very beginning after the first sale, or the 40 units of our purchase from November 5th. That will be the first 40, which we already know that comes with the cost $11. And the next thing that we're going to sell is another 50 units. But those 50 units, now they're going to come from the most recent sale from November 26, and which comes at the $12 per unit. Once we have this information, what we can do, we can calculate the cost. Our cost is 440 units here and 600 here. Now, after this sale, what we can do is we can calculate the same thing. We can calculate the sales, and the sales we already have it, $2,250, and we can calculate the cost of goods sold. And how much will be our cost of goods sold? That will be those two together. $600. Sorry, no, that should be 600. That should be more than 600. That should be $1,040. So once we have this calculation, we can calculate gross margin right away. And we can see that from the from the sale of those 90 units, we generating $1,210. The last question that we have to see is how much is our ending inventory? Ending balance of the inventory. And our ending balance of the inventory, now we have 110, and we sold 90. So at the end of the month, after the last sale on November 30th, we end up with 20 units, which coming from the very, very last purchase, which comes from November 26th. And that purchase was $12 per unit. That's how much we paid. So our ending inventory is for 20 units at $12 per unit. Our ending inventory balance is $240. That's how much cost us those 20 units, which we purchased on November 26th. So at this point, what do we know? We know our ending inventory, which is going to stay on the balance sheet. We know on the income statement, we have those two sales, total sales of $3,000. We know our cost of goods sold, which is total cost of goods sold will be, in this case, 1,360, and we know our gross margin, which is $1,640. Now again, what we have to do is get the beginning balance, identify the purchases and the purchases only, and identify the sales, and get the calculation. That's all we have to do. So that's our first purchase here. And that's our second purchase for the month. And then we have the sales. Let's highlight the sales in different colors so we can clearly distinguish the sales from everything else. And that's our information that we have available. So that's a long kind of version of the whole information. In reality, what's happened in this company? In reality, on the short version, what we can do is grab this information, flip it here, and we can see, okay, so I have my first sales, I have my second sales. I'm going to eliminate the sales because those are only sales. Now I have the beginning balance. Actually, what I can do is grab this one, paste it right here. I have my beginning balance. Then I have my purchases. After I get my purchases, I have available for sale. Which available for sale will be in two things. First, I'm going to have units, and the number of units is 10 plus from the beginning balance, plus 60 from the first purchase, plus another 70 from the second purchase. In total, I have 140 units available for sale, which comes with a different cost, but my total cost is 100 plus 660 plus $840. In total is $1,600. My sales. I sold in total 120 units, as we can see. How much we generate? Obviously, our total sales will be 750 plus 2,250, which have sales of $3,000. Why the $3,000? Because we are selling 120 units of $25 per unit. Now, the last thing that we have to do is what's our ending balance? How many left? Well, we had 140 available minus 20, 120, we have 20 available. What's the value of those units that we have? Now, since we're using first in, first out, what we have to think is from which purchase those 20 units came from. Now, the question is, and I want you to answer me this question. If my beginning balance was 10 units, first purchase is 60, last purchase is 70, and I have only 20 left, 20 units left, is it possible those 20 units to have in those 20 units from my beginning balance? Is it possible? By using first in, first out. Whatever comes first, that goes out first. That's what is sold first. Is it possible for those 20 units ending inventory to have units from my beginning balance at the end of the month? What do you think? Is it clear for everybody that it's not possible to have any units left from the beginning balance? The other question is it possible in those 20 units that left, I to have units from the purchase from November 5th? Why? Because I have only 20 units. And so first, what I'm going to sell? First, I'm going to sell the 10 units from the beginning inventory. Then I'm going to sell the 60 units from the first purchase. And then I'm going to sell another 50 units from the second purchase. So the only 20 that left is from the very last purchase, which is for $12 each. Correct? So the other thing that we can do, let's change a little bit here in the number. What if, imagine, forget about the calculations here. Imagine if I have in my ending inventory 80 units. If I have 80 units, is it possible now to have in my ending inventory units from my purchase from November 5th? What do you think? How many units will be from our purchase from November 5th left in my ending inventory? 10. Does that make sense for everybody? Okay. Let's go back to our calculation. We already calculated that our ending inventory has 20 units. And as we know that those 20 units comes from the very last purchase, which is from November 26, and the cost for that purchase is $12 per unit. Our ending inventory is going to be 20 times 100 times $12. $240 is our ending inventory balance. Now the question is, since we have all this information, what's the cost of our inventory that we sold? How much is the cost of goods sold? Well, in this case, the cost of goods sold will be simply calculation between beginning balance plus the purchases, going to give you available, minus ending inventory, we're going to get cost of goods sold. So that's going to be what we have available minus the ending inventory, and it's going to give us cost of goods sold. And that's the value of the item that we sold during the month of November. Now we can, that's the summary of all the information that we get in the beginning. So let's see if do we have justification that information. The first cell, our cost of goods sold 320. Second one is 1,040. That's in total 1,360. Our gross margin is 1,640. And our ending inventory is 240, which is exactly the numbers that we have if we do that summary calculation. Now let's label our worksheet here. That will be first in, first out on the perpetual inventory. And let's go back to slides and see what the slides tell us about this first in, first out method. Again, what the slide's going to tell us is that since we have our beginning inventory, purchases and sales, we can start working one after another. So in our first sale on November 15, we're going to sell the first 10 that we have in the beginning inventory. And the last 20, the next 20 is going to come from the first purchase on November 5th at $11 per unit. So our total cost of goods sold will be $440. Then we're going to add the other 70 that we purchased on November 26th. And then we're going to sell 90. And our ending inventory, we're going to end up with 20 units, which 20 units going to come from the very last purchase from November 26th, which has purchase price of $12. So our ending inventory balance is going to be $240. Now, once we have this, we can do this example. Now, what's this example about? First, we're going to have the beginning balance. 10 units at $10. Then we're going to have the two purchases in total 1,500. And we come up with the 1,600 value of the inventory, which contains 140 units. Then we're going to deduct the 20 units that left at the cost of the very last purchase at $12 per unit, which is $240. And the remaining is going to be our cost of goods sold, which we sold 120 units. And the cost of those 120 will be 1,360. Now, if we have to do the journal entry of all the transactions that happened during the month of November, it will be very straightforward because you're using, again, perpetual system. So first we're going to purchase the inventory, debit inventory, credit accounts payable. Then we're going to sell the inventory, credit sales, debit accounts receivables. And then we're going to show the cost of goods sold of the inventory that we just sold for 25, which is the beginning 10 units and 20 units from the first purchase on November 5th at $11. So that's going to be cost of goods sold for 320 units at dollars, and inventory going down because we don't have those 30 units anymore. That will be $320 credit on the inventory. What's going to happen next? Next, on the November 26th, we're going to purchase another 70 units. So debit inventory, credit accounts payable with 840 because we purchased 70 units at $12 per unit. And after that, we're going to sell 90 units. Credit sales revenue, debit accounts receivables. And then we have to show the cost of goods sold of those 90 units, which 90 units comes from the 40 units come from the purchase from November 5th, and the other 50 comes from the purchase of November 26th. And that comes with the cost $1,040. That's our first in first method, first out method, and journal entry, which comes with all the events related to the first in first. Now let's do the next one, which is weighted average. But since we have inventory which always updates itself with every purchase, and since we're running this perpetual system, we're going to call it moving weighted average. What means moving? Because every time when there's a purchase, the average cost per unit is going to move. And always the purchase is going to change the cost of our units by adding more. When we're selling, that's not going to change our moving weighted average cost. So let's see the example. We're still going to play with the same numbers. Let me share my screen. Again, we're still going to play with the original numbers, which come from here. But now, let's first change it. The name that will be moving weighted average method. And let me erase something. All this information I don't need it. And let's start again. Now we have moving weighted average method. Let's label the first column and the first Excel spreadsheet. That was the first in, first out. So, and again, in the perpetual system, we have this unique privilege that system to update itself every time when there's a new purchase. So what's going to be? First, we're going to have beginning balance. We're going to start again with the beginning balance. Second, we're going to have the first purchase. First purchase comes November 5th. And we purchased 60 units at 11,660. Now the question is how much we have available for sale. We can easily calculate. And now we're going to have available for sale. And we have 70 units available for sale. Also, we have the total cost of those units. Now the question is, what's the average of just those 70 units? Well, we can easily calculate it. That will be 760 divided by $70. And we come up with our weighted average for those 70 items that we have available. After that comes for sales. On November 15, we select 30 units. Now, since I already have the weighted average cost for my units, I can easily sell that those 30 units that I'm selling, they coming with the cost of $10.86. So in total, the cost of the units that I'm selling is $325.71. So again, let's do this sales here and cost of goods sold. And we can easily come up with the sales of 750. Cost of goods sold now are negative in this number, but kind of positive, and we are getting our gross margin. Which is equal to 115 minus 325. Now, what's going to happen next? What's going to happen next? We're going to see what's our available or inventory on hand. So we had 17, we sold 30, we have 40 left. What's the average cost of those 40? That will be 10.86. So how much will be the total cost here? Will be 40 times 10.86 in total, 434.29. Then we're gonna make the second purchase on November 26. And November 26, we're gonna purchase another 70. Once we make that purchase, let's see how many items we have available. Can you guys hear this background noise with the people that moving those chairs? Just a little, okay. If it's not so bad, I'm not gonna make them. Otherwise, I'm gonna start screaming here. They to stop doing what they're doing. Okay, now let's see how many we have available for sale. And we have available for sale 110 units, which comes with the cost of 1,274.29. At this point, I can calculate again my weighted average. And my weighted average, as you can see, now start moving. From 1086, my beginning inventory was 10. After first purchase, my inventory become 1086 and now become 1158. And now you can see why it's called moving average, because every time when I make a purchase, my average cost is gonna change. Just give me a second, I wanna talk to them to stop this noise. Okay, now we can go back to our calculations here without background noise. So we have available for sale 110 units, and as you can see, the weighted average have moved up. Why? Because we buy at higher price. After that, what's happened in November 30, we have a sale. And from where we're selling, now we're selling from the units that we have. That's minus 90 here. And we already have the cost of those units, which is 1158. So our cost of goods sold in this case will be 90 times 1158, and that's going to be 1042.60. So again, we can do the calculation. Sales, cost of goods sold, and our sales going to be 2250. Cost of goods sold will be negative of this number. Let's put it the proper way. And we can calculate our gross margin, which gross margin will be sales minus cost of goods sold. Okay, on the end, we're going to ask ourselves how many units we have available and what's the value of those units. So the ending balance in this case, or ending balance inventory, that's how we name it. Inventory. Our ending balance of the inventory will be 110 that we have available before the last sale, minus the 90 that we sold, we have 20. But now the cost of our ending inventory is 1158. So the value of our ending inventory is going to be different compared to the first in, first out. 231.69. And that's become the ending balance of our inventory. Now you can see now how we're moving from one to another. So every time when we're making purchase here, we're adjusting the ending balance. Every time we're making adjustment, we purchase, we make adjusting the average price per unit. And that's going to reflect our cost of goods sold. Just a second. Just give me a second. So if we have to do the summary again, we're going to put the information. We're going to group the cells separately. We're going to eliminate we're going to separate the beginning balance from the purchases and get my purchases here. And the next thing that we're going to do is, once we have the cells, the next thing that we're going to do is we're going to get the ending balance. In the ending balance, we have it here. So now let's make some adjustments. Once we have the beginning inventory, we're going to have available for sale. And our available for sale is the same amount that we had before. In the first in, first out. 10 plus 60 plus 70, 140. The total cost is the same, 1,600. Now the sales are sales. Ending inventory, however, comes with different cost now. It's 1158. And our our total sales in this case are 120 with the total sales price of $3,000, same like the first in, first out. Now the ending inventory is going to be the 140 minus 120 that we sold, 20. But as you can see, that since we're using the moving average, our unit cost per unit is going to be 1158, which is going to change the cost of goods sold. If we have to calculate the total cost of goods sold, in that case will be the beginning balance plus the purchases available minus the ending balance is going to give us cost of goods sold. And as you can see now, the cost of goods sold are different amount. Let's highlight it. So compared to the first in, first out method, when we saw the summary, our cost of goods sold was 1,360. In the moving average, our weighted average cost of goods sold goes up. Inventory, 231 here, and 240. So the inventory and the inventory balance with the moving average went down. On the first in, first out is higher. Why? Because in the first in, first out, we're keeping the last item from the last purchase, which is coming with the highest price. When in the weighted average, moving weighted average, the balance of the cost of our units is a little bit lesser than the last purchase. Why? Because we're carrying that weighted average cost of the items from the previous purchase. So now let's go back to slides and finish those slides. So the moving average, again, with every purchase, we're gonna start adjusting the price. And when we apply the moving average, we're gonna see that every time when we purchase, we're gonna change the cost of our inventory. And slowly gonna move to 1158 per unit. Until the end, and we're gonna see that we have 20 units left at 1158, and we're gonna get our cost of our ending inventory. That cost of our ending inventory, as you can see here, that's a rounded number compared to our calculation. So if we have to do the journal entry, the journal entries are exactly the same. Purchase the inventory, debit inventory, credit accounts payable for the purchase. For the first sale, debit accounts receivable, credit sales revenue for 750. As you can see from the weighted first in, first out and moving weighted average, the first journal entry are exactly the same. Then we have cost of goods sold and inventory. That's where the difference comes, not in the accounts that we have to debit and credit, but the amount that we use. Why? Because now we're not using the cost of the first in, first out that we're selling, but we're using the average cost of the units that we sell. Then on the next purchase and next sales, there's no difference. Debit inventory, credit accounts payable, debit accounts receivable, credit sales revenue for exactly the same amount. Cost of goods sold is the one that is different, and the inventory reduction, when we're reducing the value of the inventory, is different between one method and the other method. So if we have to make a comparison, which we already did in our Excel, but if you have to put it here on the same, side by side, what we're gonna see is that sales are the same, $3,000. Cost of goods sold are different. In the first in, first out, we have lower cost of goods sold compared to the moving average. Why is that? Because in the first in, first out, we're selling the cheaper inventory that we have. When the moving average, we're adjusting for the new price of the inventory slowly and moving towards the highest price. of the inventory, where in the first in, first out, we only keep the highest cost, the inventory from the last purchase, which comes with the higher cost. So the conclusion that we can make is when the purchase cost increasing, first in, first out, we're going to produce lower cost of goods sold because we're selling first the cheapest inventory. Second, higher gross margin because the cost of goods sold here in our calculation will be lower number. Gross margin is going to go up. And because of that, net income is going to be higher. However, if the cost of the inventory goes down, then we're going to have the opposite effect. Cost of goods sold will be higher. Gross margin will be lower. And the net income is going to be lower. So, account for the periodic inventory. That was perpetual. Now let's see the periodic. Periodic, it's so way easy. And the other thing is on perpetual, it's already done by the software. You don't have to do it. You just plug in the information in the software, and the software just give you the how much, when was the purchase, how many units came, what's the cost, what's how many left on the previous period, calculating the weighted average using weighted average, and assign cost to the cost of goods sold, and we do the sell. If you're using first in, first out, the software automatically pick up the items which is from the previous purchase and keeping only the items from the last purchase as ending inventory. That's easy. Now, but again, it's done by the software. And perpetual, you come in place when you have to do the calculation. Perpetual is a way easier than the periodic. Why? As you remember, in perpetual and the periodic system, we don't have to do the cost of goods sold, not until the end of the period. So basically, after every sale, we don't have to calculate cost of goods sold. So how are we going to get cost of goods sold? Very simple. First, we're going to physically count the inventory. Second, we're going to keep track of the purchases. Then at the end of the period, we're going to do the new count. So beginning inventory plus the purchases is going to give us available. We already have the sales from the inventory that we're selling, from the invoices and the inventory that we're selling. When we count, we're going to see how many left. So again, the beginning balance plus the purchases minus the ending balance that we physically count, we're going to see how many we sold. When we calculate the cost, we're going to see the cost of the cost of goods sold. And we have to make adjustment. We're going to make adjustment in the inventory system. So let's see how this is going to work in our example. First, let's remind ourselves on the periodic system, we're not using inventory. We're using purchases, purchase discount, purchase return allowances, freight in. Once we get the beginning inventory plus the purchases minus purchase discount minus purchase allowances, we're going to get the net purchases plus the freight in. We're going to get the cost of goods available for sale. Less the ending balance, which we count, we're going to get the cost of goods sold. Let's go with our example and apply the first in, first out on the periodic system now. I'm going to move back to the Excel spreadsheet. And we're going to get the first one from the perpetual and we're going to move it right here. Now I'm going to label it with this one. I need this perpetual and I'm going to change it to periodic. I don't need this calculation. We can come up with this calculation again. So first in, first out in the periodic system. What we're gonna get? Again, we're getting the purchases. Sorry, beginning inventory. Then we're gonna add the purchases. Purchase 1, purchase 2. Then we're gonna have available for sale. We already know we have the P10 plus beginning plus, sorry, that's not the one that I'm looking for here. Then beginning inventory plus the 60 plus the 70. We're getting 140. Total cost, we get the total cost. 1,600 available for sale. Then we're gonna get the sales. And we're gonna calculate the total sales. And we can see that we sold 120 and now sales for $3,000. Now the question is, what's left? Inventory and the balance of the inventory. We had 140 minus 120, we have 20. Again, we ask ourselves a question. Since using first in, first out, what's the cost of those 20? From which purchase they're coming? Logically, they're gonna come with the very last purchase that we made, which comes with the $12 per unit. So our ending inventory balance will be 20 times $240 is our ending inventory. Great. We got the ending inventory. What we have to get now? Cost of goods sold. How are we gonna get the cost of goods sold? We can easily see how many we sold. We already know that we're selling 120. The question is, how much is the cost of those 120? Let's go back to, that's 120 sold. What is the cost? Cost is the available for sale minus ending balance, we're getting cost of goods sold. That's how simple it is. Now we're not doing any moving average, not moving average, anything like that. We're just simply getting the available for sale minus the inventory cost of goods sold. In this case, what's going to happen is we're going to have sales and our sales are $3,000. We know that. We're going to get the cost of goods sold for the period, which is $1,306, and we're going to calculate the gross margin, which gross margin will be the total gross margin that we have in the perpetual system. What's the conclusion that we can make? There's no difference between first in, first out for the perpetual and periodic. The only difference is in the perpetual system, after every sale, we have to calculate cost of goods sold, where in the periodic, at the end of the month. And we're done with this. Now let's see weighted average. I'm still going to work with the same information, weighted average on the periodic system. And now we can see how we're getting this weighted average. So what I'm going to do is I'm going to delete all this. And I'm going to start from this point. Again, we have the beginning balance, 10 units, $10, $100. We have the two purchases. Once we add the beginning balance plus the purchases, we're coming with the total cost. Well, the total cost is for the 140 units that we have available. So the question is, what's the weighted average cost of those units? 1,600 divided by 140 is going to give us 1143 is the weighted average cost of our units. Now we're going to have our cells. Cells not going to change. That's our cells. And our total sales, again, the same. Nothing's going to change in the sales. We're selling those 120 units and we're getting $3,000. Now the question is, what's the ending balance of our inventory? Well, we know that we have 20 units available. And we know that average cost per unit is 1143. So what's the total of our value of our ending inventory? It's going to be 20 times 1143. It's going to be 228.57. That's my value of the ending inventory. After I get my ending inventory, now I can calculate the cost of goods sold. And the cost of goods sold, obviously, I'm selling 120 units. And they're coming with the cost at 1143. So the cost of this one should be 120 times 1143. Now, sometimes, because of the rounding, there's a mistake. So what you're going to do is you can apply the same thing. Available for sale minus the ending balance. Let's see if we get the same numbers. Available for sale minus the ending inventory balance. We're getting the same numbers. So in this case, the rounding is eliminated. So let's highlight this. That's our cost of goods sold. So what we can do exactly the same thing that we did here, sales with the cost of goods sold. But in this case, everything's going to change. Now the 3,000 is going to be a cost of goods sold. Now the sales, the cost of goods sold will be 1,371.43, and gross margin is going to be different. So if we have to compare one with another, in the weighted average, we're getting 1,640. When the weighted average, so in the first in, first out, we having 1,640. When the weighted average, we having less gross margin. That's the whole thing. Now, as you can see, the weighted average probably on the periodic probably is the simplest one. First in, first out. The only thing that you have to be careful is what's the value of per unit of our ending inventory. And keep in mind that first in, first out, you're only gonna have the last purchase, inventory from the last purchases, not at the beginning. Let's stop sharing this and let's go to the slides and finish the slides. So first in, first out. Once we look at the first in, first out, we're going to start working with the calculation. Beginning inventory plus the net purchases. It's going to give us total available for sale. Less the ending inventory, it's going to give a cost of goods sold. In the meantime, every time when we have a sale, we're going to do the journal entry for the sale. On November 15, on November 30, we're going to do our sales. At the end of the month, we're going to do the one entry for the cost of goods sold. For the weighted average cost for the periodic, again, we're going to see getting the beginning balance plus the purchases. It's going to see how much is the cost available for sale. Divided by the normal units, we come up with the average cost per unit. And we're applying this average cost per unit in our calculation. As you can see, between the first in and first out, our available for sale is exactly the same amount, 1,600, 1,600. What's changing is the value of the ending inventory, which changing the value of cost of goods sold. How are we going to apply the concept of the inventory? Which method we should choose? That's the key here. First, we have to be consistent, which means that once we choose the method, we have to stay with that method. We have to always disclose the information in which method we're using. We have to be careful with materiality and how sensitive our users of financial statements are. And the last one is we have to apply accounting conservatism. Let's go one after another. Consistency principle states that the business should use the same accounting method for the inventory, period over the period. We're not changing our mind every period. We might, but at least have to justify it and then stay with that for few periods. Why we keeping the consistency? So our information can be comparable. And people who are using the information for analytical purposes can make appropriate analysis. Disclosure principle says that the company financial statement should report enough information about what decision we're making in the company. And also, in that case, the financial statement is going to be reliable, relevant, understandable, and comparable. What we can disclose the method that we use for the inventory. If we have a different inventory, we can disclose those differently. Okay? Now, the way you see raw material, work in process, and finished goods, those are accounts which are for manufacturing company. Now, we haven't done yet manufacturing company. We're only dealing with the merchandising company and sales company. But if you see raw material, work in process, finished goods, that means manufacturing company. Materiality on different people and different users, different number can change their decision. Materiality usually is the amount that can change the user's normal behavior. For example, if you lose $5 today, would you sleep tonight? If the answer is yes, then the $5 is not material. But if you lose $50 and you cannot sleep tonight, that means $50 are material for you. So you have to decide based on the amount, what will be the amount of mistake which can change the user's decisions and going to make them change their initial decision to something else. Conservatism, we as an accountants, we always have to be conservative in terms of the numbers. So if we see something goes up, we're staying with the low numbers. Conservatism should be interpreted by the anticipate no gain, but provide all the available losses. So if we see the gain coming in the company, we're not recording it. But if we see losses, we're going to record those losses. Every time when we have doubt about the cost of our inventory, we're always going to report it at the lower possible cost. That's part of the conservatism in accounting. The other inventory issue are the you may face that inventory can be re-evaluated to the lower of cost and net realizable. What will be the effect if we have mistakes in our inventory count? How are we going to estimate the ending inventory? Obviously, there'll be always ethical issue, and how we can perform control over the inventory. Lower cost net realizable value is not a term, it's a method. In which method we comparing the two numbers. One is cost, the other one is net realizable value. Whichever is lowest, that's what we're using to value our inventory. Obviously, if we sense that the inventory that we carry in our balance sheet or our accounting system, the value is too high compared to the selling price of the same inventory, then obviously we have to lower the value of our inventory and write it down to the amount that we can recover from our inventory. Effective inventory errors is sometimes ending inventory may create have a number which is not a realistic number. It's not the number that we have on the shelf. In that case, we have to adjust the ending balance of the inventory. Inventory errors. Now, if we make errors in the inventory, sometimes those errors correct itself. For example, in our inventory count, we didn't count 5 bottles of bleach that we have in our warehouse. But later on, somebody found them and sold them. So in that case, if we adjust the inventory that we don't have those items, and later on we actually find them and sell them, the system automatically is going to correct itself and add those 5 items which was missed on the inventory count. The last thing is the the last thing or one before last is the ethical issue. Ethical issue is accountants usually tend to overstate the inventory if they try to increase the income. What that means is if I put more on the balance sheet, that means I'm lowering my expenses. Which expenses? Cost of goods sold. If I lower cost of goods sold, my gross margin goes up. If the gross margin goes up, my net operating income goes up. And how are we going to estimate the ending inventory? Now, obviously, once we know that the beginning inventory plus the purchases is going to give us the cost of goods available for sale minus the ending inventory is going to give us cost of goods sold. Once we have that formula, then we can play with that formula. How are we going to play with that formula? Now imagine this company doesn't know how much was the ending inventory, but they know the beginning inventory. Also, they know the purchases. The next thing that they know is that the normal gross margin for them is 40%. And the normal cost of goods sold are 60%. Actually, we don't even need to that 60% for the cost of goods sold. We just need the information for the gross margin, which the gross margin is 40%. If the gross margin is 40%, that's 40% from our sales. So then we can come up with the value for the sales. Sales minus the gross margin is going to give us cost of goods sold. Available minus cost of goods sold is going to give us ending balance. So let's work with this number. numbers, and let me show you these numbers, because I believe I'm going to give you a question about with those numbers. I'm going to paste this picture on the Excel spreadsheet, and I'm going to move to the Excel spreadsheet. Just in a second. Okay, I have the picture. Now, what this says is that if you're applying the formula, which is beginning balance of the inventory plus purchases, it's going to give us available for sale. Once I deduct less ending balance of the inventory, we're going to get cost of goods sold. Now, why is that? If we take a close look of the T account of the inventory, what we're going to see? I have to open the T account for the inventory. What I'm going to see here. Very interesting things. The only thing that we have to do some observation. Let me merge those two cells, and now we're going to have here debit, and here I'm going to have inventory. What we know about inventory, it's a balance sheet account. Normal balance is debit. Beginning balance is on the debit side, ending balance is on the debit side. On what's coming in the inventory, if you want to sell the inventory, we have to purchase it. And once we sell it, become cost of goods sold. So from where the cost of goods sold coming is from the inventory account. What we know about the balance sheet account with normal balance debit, we know that beginning balance plus the debit is equal to credit plus the ending balance. Now, playing with the numbers, what we're going to see is the debit which coming into this account is actually the purchases. So that's the case, beginning balance plus the purchases always going to be equal to credit, which in our case is cost of goods sold, plus the ending balance. Now depends what we don't know, what we know. If I don't know cost of goods sold, I can express it. Cost of goods sold is going to be equal to the beginning balance plus the purchases minus the ending balance. Now, if I don't know the ending balance, then it's going to be easy again. Ending balance is going to be always equal to the beginning balance plus the purchases minus the cost of goods sold. You're always going to have three of them, or you're going to have enough information to get at the three of them. Now, in this question, what we have, in this question probably is going to say the beginning balance of the inventory is 14,000. That's our beginning balance of the inventory. Then we have purchases or net purchases here for 66,000. So once I get these purchases, I can easily calculate available. My available for sale at this point is $80,000. That's how much I have available. Now, I don't know my cost of goods sold, but I know that my sales are $100,000, and I also know that my gross margin is 40%. Well, that's great. Why? Because what I can do is I can do the income statement, first part of this. And what will be the income statement? I'm going to have sales, and I'm going to have cost of goods sold. That will be cost of goods sold here. And then I'm going to have sales minus cost of goods sold. It's going to give me gross margin. What do I know? I know my sales. I know my sales are $100,000. Great. But I also know that the sales divided by sales are 100%. The next thing that I know is my gross margin is equal to the sales minus cost of goods sold. But also the gross margin in my company normally is 40%. So if I sales minus cost of goods sold, that will be cost of goods sold here. If the sales minus cost of goods sold give me the gross margin, the same is applicable for the percentage. 100 minus something has to give me 40. So I can easily calculate my cost of goods sold as a percentage are 100 minus 40%. Now, if my sales are $100,000 and 40% of those sales are my cost of gross margin, I can easily calculate my gross margin. That will be 100 times 40%. Now, what's left for the cost, my cost of goods sold? For the cost of goods sold left only to be 100 minus 40,000, 60,000. So now I know that. So what I have to do is, if the question asks you here, you have the beginning balance, purchases, sales, gross margin, and here the question may ask you, what's the ending balance of the inventory? What is the ending inventory balance? Well, from this calculation here, you can easily get the cost of goods sold. Once you get the cost of goods sold, you have the beginning balance, you have the purchases, now you have cost of goods sold. You can calculate the ending balance. So in that case will be, once you get those three, let's put it, actually, cut it from here, I'm gonna put it here. So beginning balance, we're gonna add the purchases, then we're gonna less cost of goods sold, which we already calculated is 60,000. It's gonna give us ending balance. Ending balance for our inventory is gonna be equal to available minus cost of goods sold. So again, if you know the available, either cost of goods sold gonna be given to you, and you have to calculate the ending balance. Either ending balance gonna be given to you, and you have to calculate the cost of goods sold. but you're going to have enough information to calculate either of those. That's with the calculation of the ending inventory based on the gross margin percentage and the inventory and the purchases. That concludes our slides for chapter 6. Now, the retail method, I'm not gonna ask you for the retail method. We're not gonna do the retail method. The only method that we're gonna do is the gross margin method. For the calculation of the inventory, that's why we are. So at this point, what we can do is I'm gonna give you a short break. Do you see any problems with this question?
No, it's pretty straightforward.
It should be, right? We have the sales, we have cost of goods sold. Once you know the sales minus cost of goods sold is gross margin, minus operating expenses, net income, the rest is just calculation. If sometimes give you trouble, put it on the Excel spreadsheet, put the formulas, and you're gonna get a result. That with that, let's put for the recording, for the purpose of the recording, this question 1 again, just to have it as a recording. Let me see what this question is here. On the question 1 was again just to match the definition with the appropriate terms and the appropriate scenarios. Just to have it here for the recording, question 1 and different definitions. Stop this recording, stop this sharing, and let's go with this other question, which the other question will be, let me see, this question 3. Yes, this is the question that we want me to look at. So just give me a second for paste this one as a picture, and we can start working on this question together. Just have to get some adjustments from the Excel spreadsheet. See where we are. Who we are. Paper is here. And what we have to do is put just a second, put the requirements, and I can share my screen. That will be question 3 from the set of questions which are posted on Blackboard. Okay, I have it. Now let me share the screen. Oh. Yeah. I thought I lost it for a second, but leave here. Okay. Can you guys see my screen? All right. So this question is this company is a retail store who has the following transaction in March. Purchases, paid, shipping, return something to the company, and send check to the company. Now assuming both beta and alpha use a perpetual inventory system, not periodic perpetual, present journal entry for beta company, present journal entry for alpha company. Now with the perpetual system, inventory system. When we purchase it, inventory, we keep everything in the any return, any allowances, any discounts, everything goes to the inventory account. Shipping that we pay goes to the inventory account. Perpetual system, again, when we're doing the sales, if we have to show the sales, every time when we have a sales, we have to show the cost of goods sold. So let's go one after another. So March, let me make this one bigger here. This section is gonna increase the sales value. And we start with March 2nd. On March 2nd, what will happen is we purchase from this company following item 1,800 invoice price, free on board factory, cost of the merchandises from Alpha company. So we purchase the merchandises. Let's purchase those merchandises, debit inventory. And our inventory, that with the amount that we purchase, let's make this one here. I'm gonna leave this one for credit. Here, and those two, I'll leave some space here. And those two will be my debit and credit. So just put it down. And this will be my debits and credits here. Okay, let's go one after another. So we purchased the inventory 1,800. Let's make those one as a number. So I don't have to come and check it all the time. 1,800 inventory purchase. And we're gonna credit, we purchase on account. We're gonna create accounts payable with $1,800. That's our first entry on March 2nd. Let's go with the next one. On March 3rd, we pay shipping for the shipping charges on the purchase of March 2nd, and we pay cash. Let's go with March 3rd for the shipping debit inventory. We're gonna increase our inventory directly with $125, and we're gonna pay cash credit. Cash. Will be same amount, 120. Next one. We return on March 4th, we return to Alpha Company unaccepted merchandises that had the invoice price of $300. So let's go with this, March.
Why are we debiting inventory for shipping charges?
Sorry? For the shipping charges, because we use perpetual inventory system.
Ah, okay.
Right? Once we're using perpetual inventory system, it says in the question, perpetual system. Once we're using perpetual system, we're charging everything to the inventory account. If we're using the periodic system, then we're going to have separate account with the freighting. Remember?
Okay, thank you.
Right? That's why it's important for you to identify in the very beginning, do you have a perpetual or periodic system? When it says perpetual, on the purchases, everything goes in the inventory. When it's periodic, then we're putting everything separate account. So let's go again here on March 4th. Now, what's happened on March 4? We return some unacceptable merchandising for which we have to pay $300. So since we're returning them, we don't have to pay anymore. So that will be debit accounts payable. We're going to reduce our accounts payable with the 300. And since we ship it back, we don't have it in our inventory. We return the inventory, send it back to the seller, and we don't have to pay for it. Credit inventory with $300. Let's see next one. Next one is on the March 17th. We have to pay. Now, the question is how much we have to pay. Originally, we purchased 1,800. We ship back, we send back 300. So that reduces our accounts payable. So our accounts payable that we have to clear is for $1,500. So if we have created accounts payable 1,800, we debit 300, and now the other debit 1,500. Our accounts payable is gone. Now we're gonna pay cash, definitely. But we have to see how much cash we're gonna pay. Since we're paying within 15 days, we're gonna take the 2% discount, which is offered by the seller, and that's gonna reduce our inventory. The value of our inventory, credit, was gonna go to the inventory. And now our inventory is gonna get even cheaper. Why? Because we're using that cash discount. And the cash discount, as we can see, is 2% if we pay within 15 days, but that's on the outstanding balance, which outstanding balance 1,500. So we're going to have 0.2% times the outstanding balance 1,500. That's going to give us $30 discount. And we have to pay the remaining as a cash. So our cash that we're going to pay, we're going to be only $1,470. Now let's check what's happened with our inventory. In the inventory, how much is the cost of our inventory? Let me open one T account here. I'm gonna grab the T account. I believe I have here this T account here. Let me grab this T account and just paste it right here. And let's see now what we have in our inventory. We purchased the inventory for $1,800. Let's pretend our beginning balance is 0. Then we return 300 inventory. And then we reduce with another 30 the inventory since we use that discount. So what's the value of our inventory? Inventory will be beginning balance plus purchases minus return minus the discount. So our inventory is $1,470. Isn't that the cash that we paid? That's exactly the cash that we paid for that. Now we have another cash that we paid, but that was for the shipping. Now we're going to increase that inventory as well, but that's different, the different cash that we pay. So we pay two cash, one for the shipping and one for the accounts payable. Make sense? And accounts payable are closed because we have 1,800 in the credit, 300 on the debit side, and 1,500 on the debit side. Those are closed. Let's put here the shipping. Now our inventory is going to be plus 125. But the point was you to see that the cash that they paid to our supplier, it's exactly the value of the inventory that we have without the ship. Okay, we did this for the point of purchase. If we're purchasing the inventory, that's what's going to happen. Now let's do the same thing, but from the seller's point of view. Let's mark this with green and put some net here so we can have like a beautiful general ledger. Now let's do the same thing, but from the point of view of the seller. Let's go again, March 2nd. Now we're selling. The company sold for selling merchandising to the company beta. So what's happened now? We're going to debit accounts receivables because we're selling to the client merchandise at $1,800 and he's not paying us. And we're going to credit sales with the same amount, $1,800. That sales comes with the cost. Since we're selling merchandise, that's come with the cost. So we have to show the cost of goods sold and reduction in our inventory. And remember, we're using perpetual system, so every sales transaction has to be accompanied by the cost of goods sold. So we're going to have here debit cost of goods sold. And we know the cost cost us $990. And our inventory, we're going to reduce our inventory with $990. And we're done. On the shipping, that shipping is related to the company that purchased the inventory, so we're not doing it. Return. Let's go now with the return. The return is going to be affect us. So let's see the return. That's going to be on March 4th. Now the customer returned the items back to us. So what we're going to get? First, we're going to get debit. First, we have to, since he returned the items, obviously, we're going to give him sales return. And that's going to reduce our accounts receivable, so the money that he's going to pay us, correct? So first, we're going to debit sales return and allowances with $300. Then we're going to reduce the amount that he's going to pay. Accounts receivable is going to go down with $300. And then we have to show that we're getting the inventory back, debit inventory. The inventory is come back to us, and that inventory original cost was 165. That inventory come back to us, and that's going to reduce our cost of goods sold with 165. The last thing that left is the client's going to pay us. Great. Let's see how much he's going to pay us. He's going to pay us whatever he owes us, less 2%. So let's see, on March 17, what we're going to get? We're going to get debit cash. Now the question is how much cash we're going to get? Well, we're going to get exactly the cash that the client sent us. Remember, this company wrote a check for 1,470, which was sent to the vendor, which vendor in this case with us. So the check that we're gonna get is exactly the same that the company sent us, $1,470. That is gonna close the accounts receivables. Now, as you remember, the client has to pay us 1,800. We give him a return for 300. So we reduce the accounts receivables. So the accounts receivables that we have to close here are for $1,500. So we are short on the debit side. So the client pays $30 less. What will be that for us? That will be debit sales discount or early payment in this case, and that will be $30. And we are done with this transaction. So as we can see is, let's see the logic. This one is when we are better. And this one is when we are alpha. Let's do the same thing here. And let's observe those journal entries for a second. This is when we are alpha. One thing I want you to notice is, whatever our sales is, whatever accounts receivables is for us, it's accounts payable for the other company. Every time when the accounts, we give them return and accept their return, the accounts payable going down and our accounts receivables going down. The check that they're sending us, the cash payment that they're sending us, coming directly to us for exactly the same amount. And the reduction of the inventory that they're getting is the reduction of our sales that we getting now. So the accounts payable is closed, but the accounts payable that we're closing, it's exactly closing with our accounts receivable. So whatever it's accounts payable in one company, it's accounts receivables in the other company. The cash that one company says send us a payment, coming as a cash to another company as a payment. So one company debit cash, the other company credit cash. One company credit accounts receivables, the other company debit accounts payables. That's what I wanted you to see here, and to see how the same transaction on the different parts of the transaction, we can see the logic and how the different company treating it. Depends on whether you're a vendor or you're the customer. Okay, that was the question. Now, the other question that I want you to do is, that will be question, I believe it was question, let me see which question is. Question 3. Question 3 here. The other question that I want you to do is closing entries. But now closing entries, I want you to do closing entry for the perpetual system. Sorry, no, perpetual, periodic system. Stay on the Excel spreadsheet. I believe you still see my Excel spreadsheet. Yes, you're still doing it. Let me post the information here that they have for this company. And this company has the following. Extract this, in this case, from the trial balance. Now, this is not a trial balance because it's not in balance. It's not a balance sheet. It's just extract. It's a worksheet, as you can see. If we run the balances, they're not going to match. The debit's not going to be equal to credit. Now, what we can see here is first thing that I want you to learn is to observe the information provided and think what kind of company that might be, what kind of system this company can use. So we have a cash, we have accounts receivables, we have inventory. The year here is 2023. We have inventory on the previous year, inventory at the end of this year. So once you have those inventory of the previous year and the inventory from the current year, that means we're definitely running periodic company, merchandising company, which using periodic system. Next thing that we can see is this company has sales discount, sales return allowances, and then they have in purchases, purchase return allowances, freight in. So definitely this company is using periodic system for the inventory system. All right, so once we have this information, we can start thinking of what will be the closing entries that we have to do. We have to do the regular closing entries, which are the closing the revenue, closing the expenses, closing the income summary, and closing the withdrawals. Those are the regular entry. Plus, we have to close all the accounts which are specific now to this type of inventory system, which is in this case periodic system. So in the first one, we're gonna close the sales revenue, and we're gonna close everything that has a credit balance. That will be purchase return allowances. That will be the first entry that we're gonna do, and we're gonna close everything in the income summary. Second, we're gonna close all the expenses. Plus, we're gonna close anything else that has a debit balance, including the sales discount, sales return allowance with purchases, and freighting. That will be our second journal entry. And we're closing all those accounts in the income summary. Then we're gonna close the ending balance for the period, and we're gonna open the beginning balance for the period, and we're gonna open the ending balance for the period. That will be journal entry number 3. Again, we're gonna open and close everything in income summary. Then we're gonna check the income summary, and we're gonna close the income summary. That's number 4. And number 5 will be to close the withdrawals. And that's how we're gonna close all those temporary accounts, which are cumulative accounts, which are used only for the period. And we're gonna leave only the balance sheet accounts with the ending inventory balance of 351. So let's start working and see what we're gonna do. First one, closing, sales, and credit balance accounts. What we're gonna have? We're gonna have debit, sales revenue first. Then we're gonna have debit, purchase return allowances. And we're gonna close, as we said, everything we're gonna close in income summary. So our entry will be debit and credit. Let's make those one bigger here. Those two, probably those two. And the sales revenue that we're closing is that much. Return and allowances is that much. So the total that goes to the income summary is going to be equal to this amount plus 1,600. It's going to be total $837,000. Second entry that we're going to do, we're going to close expense account plus debit balance accounts. So since they have a debit balance, we're going to close it on the credit. Then we have to debit something. Then we have to debit income summary. And then we start closing. Credit. First, we're going to credit. Let's go with utility expense first. Let's close the expenses first. Then we're going to closing amortization. Then we're going to close the miscellaneous expenses. Then we're going to start closing the accounts which are related to the nature of the merchandising business, which also have debit balance, but at the end of the period, they have to end up with zero. Sales discount is first, then we're going to call sales return and allowances. Then we're going to close purchases. And those are the accounts that we have to close. Let's go one after another. Utility expenses equal to this amount. We're going to close this one. Then we're going to close the amortization. We're going to close miscellaneous. Oh, I forgot to close the freight in. That's going to come to that freight. Let's close the first. Let's close the sales return allowances, sales discount, return allowances, and the purchases. And the last one that left is credit freight in. And the freight account has the debit balance of $1,200. So once we get all those accounts, I can get the total debit to income summary. That's going to be sum of all those accounts. So I have my second entry. Let's keep going. Next entry. We have to close beginning balance of the inventory and open the ending balance of the inventory. So the beginning balance of the inventory, let's see, where is it? It's on the debit side. So we have to close it as a credit. So we're going to debit income summary account, and we're going to credit inventory of December 31st, 2022. The amount that we're going to the credit here will be exactly the same amount that is on the debit side of that account, 345, and we're gonna debit the income summary with exactly the same amount. So we close the beginning balance, which is the ending balance of the previous year. Now let's open the new balance debit. Now we're gonna end up with inventory December 2023. And we're gonna debit this amount. Again, this is a worksheet. Don't get mistaken, this is not a trial balance. This is just a worksheet that we're working. Income summary with the same amount, 351. Once we have those, we can now open the income summary and see what's happening with the income summary account. In the income summary account, as we know, we only gonna have accumulation here, and at the end of the period, we have to bring it down to zero. So let's see what's coming in the income summary. First, from the revenue, closing the revenue, we have on the credit side 837. From the closing the expenses and debit accounts, we have 426. From the inventory, first we have the closing the ending balance of the inventory, beginning ending balance previous year inventory, and opening ending balance of the current year inventory, 351. And that's all we have. So now with what we have to do, we have to run our totals and see where we are. So we need something on the debit side. Our credit is higher, which is great. That means the revenue is higher than the expenses. So in that case, we need to balance it and bring it to zero. The amount that we need is $417,000. So what we have to do, we have to debit income summary with the same amount. So let's go with the next entry, closing income summary. So what will be that? Debit income summary. And we're gonna debit income summary with this amount. And we're gonna credit owner's equity or capital with the same amount. And the last thing that left is to close those withdrawals. Let's close those withdrawals. And that will be debit owner's capital now. And credit owner's withdrawal. And the owner's withdrawals are for $53,000. So let's close at 53 here. And the same amount. We're gonna come right here. And we are done with this. Let's get this number so we can be this close. This one's gonna be this one. And now it's more present. And that's how we're closing the accounts for the company that having merchandising operation and running periodic system. Now, what's going to be perpetual? If we have to do the perpetual, what's going to be different? First stage will be the same, except we're not going to see the purchase return allowances. We're just going to close the sales revenue into income summary. Second part, we're going to now start closing the expenses, plus we're going to close only the sales discount, sales return allowances. We're not going to have purchases in the freighting. Those not going to be available for the perpetual system. Closing ending balance from the previous year and opening the ending balance for the current year, that's not going to be available. Obviously, closing the income summary, that will be there, and the withdrawal is going to be done. So we're going to have less steps, one step, full step less, and all those different accounts for the purchases, freighting, and the purchase return allowances, those not going to be there. That's what's going to be different between periodic and perpetual. We have to do the closing perpetual. Next time we're going to do more practice because historically I can see that this merchandising inventory calculation of the cost of goods sold, ending balance give you a little bit trouble. So for that reason, we're going to do a little bit more practice on this, if that's okay with you. One last question that I wanted to show you, just to show you, so you can have a sense of it, is question number, let me see which question is. Question number 5. I'm just going to show it to you, and that's where we're going to end up. On that question, let me see again. Again. And what's important, what do I want this question is, the reason for this is that here in this question, you can see that we're dealing with, first part, we're dealing with a company that's using periodic inventory system. And starting with the purchases, purchase less the purchase discount, less purchase return allowances, plus transportation in, is going to give you the cost of goods purchased. We're going to get the beginning balance, and we're going to have the cost available. We're going to deduct the ending balance, and going to come up with the cost of goods sold. I want you to pay attention and remember that purchase discount are less. Purchase return allowances, less. Transportation, add. That's how we get in cost of goods purchased. On that second calculation, we can see the calculation now, how do we come up with the net sales. We're going to have sales minus sales discount minus sales return allowances, net sales. Cost of goods sold, gross margin. Then expenses, gross net income, and the gross profit ratio, which is equal to the net income divided by sales. Actually, no, it's not the gross. Here is 51. So the gross profit. So the gross profit divided by sales. Nets of sales. This one is equal to 51. Here, as you can see, divided by the net sales. That's how it's done. Again, this is only for you to see it and to practice and to get comfortable with calculation cost of goods sold on the periodic inventory system. That's all. And that's where we're gonna end up today.